Hello friends, today we're embarking on a journey into the world of SoftBank and its monumental vision fund. Think of it as a $100 billion plus treasure trove that reverberated through the very foundations of the venture capital world. We'll traverse SoftBank's storied past, witness the inception of the vision fund, and probe into whether its massive footprint has been a boon or a bane for the industry. We'll also delve into WeWork's tumultuous narrative and shed light on its recent economic headwinds like significant rate hikes. And as we stand on the cusp of the summer of 2023, we ponder, what does the future hold for SoftBank? Stick around and let's decode the saga. Now cast your minds back to 1981. The digital realm was just taking baby steps. In comes Masayoshi Son, a fiery 24-year-old with a Tokyo-sized dream, laying the foundation stone for what we today recognize as SoftBank. Starting as a modest software distributor, SoftBank's ambitions didn't stop there. It pivoted, venturing into the realms of tech publishing and then glossy magazines. In a short span of 13 years, the company made headlines, boasting a jaw-dropping $3 billion valuation upon its listing. The globe watched, almost in slow motion, as SoftBank's trajectory pierced the skies during the dot-com bubble of the mid-90s. Remember the buzz around the Yahoo joint venture in 1996? That was SoftBank, already strategizing its next chess move. As it transformed into a formidable holding entity, Son was meticulously curating the blueprints for SoftBank's magnum opus. Brace yourselves, because SoftBank was about to redefine the financial success stories. The strategic investment of a mere $20 million in the then uncharted territory of Alibaba amplified into an astonishing $60 billion in return. Process that for a second, from $20 million to a staggering $60 billion. This wasn't just victory, it was a masterstroke. With confidence and capital both riding high, Son envisioned an even grander tableau, setting the stage for the formidable vision fund. And believe it or not, this, dear viewers, is just the starting point. Buckle up, because 2017 was a whirlwind in the world of venture capital. SoftBank, after amassing a trove of tech acquisitions, pulled in partners like the Saudi Public Investment Fund and big hitters such as Apple. Together, they unfurled a staggering $100 billion vision fund. While this might sound like another impressive number in the realm of venture capital, this was a seismic shift. Imagine the venture capital scene as a pond. Before 2017, this pond held a modest $84 billion, with titans like Andreessen Horowitz managing assets around $35 billion. Enter SoftBank's vision fund, more like a tsunami than a ripple, injecting another $100 billion to the scene. It wasn't merely a disturbance, it redefined the ecosystem. Rather than meticulously sifting through startups, SoftBank set its floor high, a whopping $300 million investment. For a startup to even kickstart a conversation, they needed to be primed for that magnitude of capital. This new approach stoked asset inflation. Pouring more money into the market without a corresponding rise in value propositions meant prices inflated at a breakneck pace. In this frenzied environment, startups, sometimes with just embryonic ideas, quoted valuations that seemed plucked from fantasies. Conventional venture capital valuations were sidelined. We were witnessing a gold rush, but this time with SoftBank setting the gold standard. Next in line under the Vision Fund spotlight was WeWork. Visualize towering skyscrapers, the infectious buzz of activity, buzzing entrepreneurs, and a revolutionary perspective on office spaces. WeWork, championed by its charismatic CEO Adam Neumann, quickly became the toast of the town. From its grassroots origin to an awe-inspiring $47 billion valuation, they seemed to turn everything to gold. But then, in a dramatic turn of events, the Vision Fund stirred onto the stage with an unambiguous objective to secure the pole position in every groundbreaking startup shareholding. This applied to stalwarts like Uber and notably WeWork, adopting a strategy baptized blitzscaling by LinkedIn's masterio Reid Hoffman. The goal was straightforward: accumulate capital swiftly, expand at rap speed, and commandeer a market leadership. Intriguing, isn't it? However, the narrative took a wild detour. The Vision Fund's interest in WeWork wasn't cursory, it was profound. So deep was this commitment that, as sources hint, an eye-watering $3 billion was channeled into WeWork post a brief 12-minute meeting with Newman in 2017. This wasn't the careful, calculated investment norm, it was an instinctive gamble on a grand dream. Yet, deviations emerged. The venture capital sphere, known for its structured investment series from seed to Series D, watched in astonishment as WeWork sprinted headlong, reaching Series H. With each funding lap, its valuation surged. By 2019, the tally of the Vision Fund's stake in WeWork stood at a staggering $17 billion. However, all that glitters isn't gold. Beneath this shimmering veneer lurked imperfections. Whilst the bulk of flourishing tech firms reached a threshold where profits roll in, WeWork was an anomaly. Recognizing this would mean unsettling the status quo and potentially casting WeWork's fund foresight into doubt. 2019 unfurled more theatrics. As WeWork set its sight on one of the global premier IPOs, its valuation was unmatched. Fast forward to 2023, and retrospection on the saga feels akin to reliving an epic filled with staggering ascents and shocking descents. Venture capital, with all its glitter and glamour, can sometimes feel like a thrilling roller coaster ride. So what's the end game for venture capitalists? The exit door. Every VC or venture capitalist hopes for that shining moment when they can exit with a bucket full of profits. Think of it like a magic show. You invest early, wave a wand, or wait a few years and then poof, cash out big. That's the dream, right? But here's the thing, you need the right door to exit. And recently, those doors have been kinda stuck. WeWork was like a dazzling star everyone wanted a piece of. It stirred around with a tech label, but at its core, it was an old school office rental business. When they started talking about community adjusted EBITDAs, you know, kind of like how your friend tweaks their dating profile. Alarm bells began to ring. Now consider the curveballs that the market threw in, COVID and the rate hikes. It's like the universe said, let's shake things up. For most VC-backed startups, especially the mature ones, these events become a huge reality check. Suddenly, they were the kid outside a candy store, nose pressed to the window, but pockets empty. But here's where it hurt. SoftBank's Vision Fund was like a party host handing out free drinks, inflating the mood and valuations. When the party ended, they were left with the bill. To visualize this, imagine filling a balloon. SoftBank's fund keeps pumping in air, making it bigger and bigger. But when the environment changed and that balloon was let go, it didn't gracefully float, it plummeted. Fast forward to now, and SoftBank with its Vision Fund, it's feeling the aftershock. Their lofty valuations now seem more like mirages in a desert. Sure, you can blame external factors, but at its core, it's about understanding the balance between aspiration and reality. And that, friends, is the thrilling, chilling tale of the VC market trend in the recent times. Now, can you imagine a staggering $32 billion burned away in losses? That's the cost SoftBank bore from March 2022 to March 2023. It's almost like watching a meteoric rise followed by a thundering crash. And this wasn't just some abstract number. Real companies, real ventures felt like ripple effects. Take Swiggy for instance, India's renowned food delivery service. Here was a company shining brightly, only to witness its valuations being shaved off by over $5 billion. It's as if overnight the shining star just dimmed. Then there's Ola, the popular ride-hailing company from India, once basked in glory. But recent times, they found themselves valued at figures lower than what they enjoyed back in 2019. It's not just a number game, but stories of ambition, dreams, and the unpredictable twists of the business world. So as we piece these tales together, remember, the business realm is a roller coaster, and the giants like SoftBank are not always immune to these steep drops. Now let's embark on the next chapter of SoftBank's thrilling journey. Remember WeWork, the behemoth that once soared only to plummet. Its post-IPO value post its SPAC merger in 2020 has dwindled to a mere 2% of its former glory. That's a breathtaking dip from the sky-high valuations that the Vision Fund placed on it. A staggering $17 billion vanished into thin air for SoftBank. But every story has its twists and turns, and the Vision Fund saga is no exception. Glimmers of hope are beginning to shine through the storm clouds. After 6 tumultuous quarters, SoftBank finally has reasons to celebrate with its first quarterly profit. The strategy? A more cautious approach. Fewer deals, reduced staff, acknowledging past mistakes, and bracing themselves for the road ahead. A pivotal moment on the horizon is the IPO of ARM, a jewel in SoftBank's crown. If the predictions are accurate, this IPO could infuse SoftBank with a whopping $60 to $70 billion, reminiscent of the Alibaba windfall years ago. As the sun rises on a new day for SoftBank and the Vision Fund, many believe the company's brash investing style will evolve, becoming more calculated and discerning. The entire venture world watches with bated breath, hopeful for a wiser decision in the next business cycle. In today's exploration, we journey through SoftBank's evolution from its humble 1981 beginnings to becoming a venture capital titan. We marveled at the astronomical Alibaba win and the birth of the $100 billion Vision Fund, which forever transformed startup valuations. WeWork's tale exemplified the peaks and the valleys of SoftBank's Saga, a dance of ambition and reality. Recent financial storms shaved billions from SoftBank's portfolio, with giants like Swiggy and Ola feeling the tremors. As the horizon unveils a cautious, a more evolved SoftBank, the world anticipates wiser choices in the next business chapter. Through triumphs, setbacks, and lessons, SoftBank's saga reminds us of the volatile yet fascinating dance of the business realm. I want to hear from you. Do you think SoftBank's new approach will see more successes, or will history repeat itself? Drop your thoughts in the comments below. If this deep dive into SoftBank and the venture capital world enlightened you, please hit that thumbs up. And to embark on more such journeys into the business realm, don't forget to subscribe. Together, we'll continue unraveling the tales behind the titans of the industry. Until next time, stay curious and keep exploring. See you in the next video. Bye for now.